Hello everyone, this is Arnaud Delapierre. Today, we are going to talk about a must-know subject for those starting in the stock market, ETFs. If you're looking for an investment that is simple, transparent, and accessible, you're in the right place. In this video, I will explain why these exchange-traded funds are, in my opinion, the most user-friendly option for novices. We'll discover together how they work and why they appeal to so many, to those who want to step into investing without tearing their hair out. Stay tuned until the end. We start right away. ETFs, or exchange-traded funds, are publicly traded funds that group together a set of stocks or bonds within the group. Instead of buying each security one by one, you buy these funds as a single stock that get access to a diversity of investments with just one click. This formula appeals to many people because it's designed to spread risks and simplify the investment approach. You don't need to be an expert to get started through a single product. You get broad market exposure. This accessibility pairs perfectly with passive and economical management. The simplicity of use is among the major advantages of ETFs. With a single product, you benefit from diversification across hundreds or even thousands of different securities. For a novice, it's a relief to know that you're not betting everything on a single company. You can sleep more soundly, knowing that an isolated drop won't affect the entire portfolio. Moreover, passive management reduces fees compared to an actively managed fund, which can make a real difference in the long term. It's a tool that allows you to start without too much stress and to get initiated into investing. Before continuing, let me give you a little intro. If you're looking for a practical app for your trading decisions, I have a recommendation. The Notrade app. It is available on iOS and Android, and it allows you to receive effective signals to better manage your positions. The app is completely free. It offers a clear interface, ideal for spotting opportunities and acting quickly. Its community is also an asset for discovering different approaches and learning at your own pace. With our help, you get a boost to make more informed decisions while remaining fully in control of your account. Don't hesitate to give it a chance. I can assure you that you will adopt it. ETFs appeared in the in 1990, the 1990s, when certain market players wanted to design a product combining the flexibility of stocks and the distribution of a traditional fund. The first ETF based on the SP 500 index quickly became a benchmark. Its success led to an abundance of new offerings. Today, there are ETFs on almost everything, from major stock indices to specific sectors, including bonds and commodities, and more recently, the Bitcoin. This evolution has given investors an impressive catalog with the possibility to target precisely what interests them. A small revolution, in short. Among the reasons for their popularity, we unsurprisingly find the generally lower fees compared to actively managed funds. ETF managers follow a benchmark index, so there are fewer decisions to make and reduced operating costs. Investors benefit because, over time, even a small fee difference can have a significant impact on the final performance. The concept is simple: save on costs to retain a larger share of the profits. This philosophy particularly appeals to those starting out, as no one, likes to have their gains eaten away by fees, but absolutely no one. I repeat, no one. Another advantage is their continuous trading on the market. At any time, during opening hours, one can buy or sell an ETF just like one would do with a regular stock. In reality, if you spot an opportunity and wish to take a position immediately, it only takes a click and it's done. This also allows for reactions in case of a sector shakeup. This flexibility is particularly appreciated by those who want to keep an eye on their portfolio and act if they deem it necessary. There is no need to wait until the end of the day to know the price, which provides more transparency to the system. Even if the allocation within an ETF can offer some balance, never forget forget that it remains a stock market investment. Price fluctuations are normal and can be unsettling when you're starting out. The idea is to clearly target your objectives and compose a coherent mix. Some choose, for example, a generalist ETF on a broad index, then add a few sector ETFs for diversification. That's why not a tech sector? For example, for technology, we can also adjust the bond portion if we want to limit volatility. The important thing is to define a clear plan and have the patience to follow it over time. To get started, it is often recommended to begin with an ETF that replicates a major index. One might think, for example, of the S&P 500 to the MSCI World or other indices known for their breadth and relative stability. This allows for obtaining, in a single position, exposure to several hundred companies from various sectors. Once you're comfortable, you can explore other options like sector-specific or bond ETFs. Before clicking on buy, take a look at the management fees and the size of the fund, just to ensure you're choosing a solid product. Be careful not to spread yourself too thin with too many ETFs. Accumulating them without a strategy can complicate management and increase fees. Another trap is relying blindly on past performances. An ETF that performed well last year is not necessarily a guarantee of future success. Also, pay attention to the type of replication. Some ETFs actually purchase securities, underlyings. Others use derivatives. This is not necessarily a problem, but better to know what you are investing in anyway. Take the time to read the documentation to understand the philosophy and composition of the ETF in question. On my end, I became interested after being around experienced investors who praised the simplicity. I discovered a way to diversify my investments without having to analyze dozens of financial statements. Of course, it doesn't do everything, and I made mistakes, especially by rushing into opportunities that were too good to be true. Over time, I understood the importance of staying disciplined and prioritizing thoughtful allocations. Exchange-traded funds helped me stabilize what used to go in all directions. Then, it's true that their passive aspect suited me well. Over time, I managed to deepen my techniques. An approach often adopted by beginners is to invest a fixed amount each month, whatever the market mood. This method, called dollar cost averaging or DCA, allows you to smooth out risks and avoid worrying too much about timing. You buy ETF shares regularly, whether prices are high or low. In the long run, this approach can promote more stable growth as it avoids putting everything into one. Many people like this strategy because it brings a form of automation and removes a good deal of stress when making a purchase. Personally, I don't like this method at all. I prefer to wait with my cash. When there's a drop of 15, 20, 30%, well, that's when I enter. ETFs have gained popularity because they go beyond temporary trends. In a crisis, a broad ETF sometimes proves more resilient than overly specialized investments. When a company or sector suffers, the diversity included in the ETF can offset this decline. Of course, it doesn't guarantee that everything will go as planned, but it avoids to rely entirely on a single stock. The flexibility also attracts more experienced investors who use them to quickly adjust their positions in certain markets. Every profile finds an interest in them, from complete beginner to confirmed expert. Many think it's only for beginners, but it's extremely wrong to think that. Obviously, there is no absolute secret to winning on the stock market, and even ETFs carry risks. It's why it is wise to continue informing yourself, comparing different offers, and forming your own opinion. The advice I share is based on my experience and does not constitute an official recommendation. Do your homework before investing, and do not hesitate to consult a professional if necessary. For my part, I consider that ETFs are the ideal entry point to learn about the market without spread themselves too thin. Everyone remains free to adapt this approach according to their objectives. My personal advice advice is that a portfolio should consist of 7 stocks. Not more, no less. That's my theory. In summary, exchange-traded funds offer an easy way to access a wide variety of securities without needing advanced technical knowledge. They are perfectly suited for beginners thanks to their diversification, reduced fees, and flexibility in buying and selling. With a well-established plan and a minimum of discipline, they can become a valuable ally in the quest for peaceful financial progress. If you enjoyed this video, subscribe to the channel now and give a thumbs up to support me. I'm looking forward to continuing this adventure together, so stay tuned and see you very soon.